Thank you for checking out Real Talk Personal Finance. Shit's about to get real. Cash Flow King with you today, and today we are doing an episode with a returning guest, which we'll introduce here momentarily. The title of today's podcast is going to be Real Estate Syndication Update, Can You Handle the Ride? Featuring O-Dawg. Before we get into today's show, as always, just a couple of quick announcements, really just one. There's a brand new feature that Buzzsprout, who the Real Talk Personal Finance podcast uses to host these shows, they've come out with a new feature. It was kind of a play on the old AOL back in the day. You got mail. And it's like fan mail, basically. But there's a link in the show notes. If you click on the description of any of the shows, it'll be towards the top, and it will say, send us a text message. So you can actually text the Real Talk Personal Finance podcast. It's a lot easier than sending an email, and you can do that right from the show notes. If you just click on that message, it will bring something up. I actually tested this out. It will bring up a text, and it will have like a numerical code, and it says, please don't change. So just leave that part alone. But right after the colon, you can type in whatever you want. If you want to send us some words of encouragement, hey, great show, enjoyed this episode, keep up the great work, whatever you want to say, we will see that. I have that linked actually through the Buzzsprout app on my phone, so I'll be able to see any of those that come in. Unfortunately, at this time, I did reach out to Buzzsprout, and we are not able to text you back, or at least just yet. And I'm hoping for that functionality to change and for that to become available. But as of right now, it's kind of still a one-way communication medium, if you will. So you can send us a text by clicking on send us a text message, and you can text the show. Again, we can't write you back, so if it is something that warrants a response or you'd like a response, email is still, as of right now, probably the best way to go, which is realtalkpersonalfinance@gmail.com. I realize it takes sometimes a few more clicks and a little bit more effort to send an email, so I think that's part of the reason that Buzzsprout has come out with this new feature called Fan Mail. So we are really excited about it as they continue to grow their platform, and as always, thank you to everybody who supports the show, especially our premium subscribers. Speaking of, that is a good segue in transition into our third ever guest back on the show, who is a premium subscriber, and we really appreciate that. Please welcome back to the Real Talk Personal Finance podcast, O-Dawg.
Thank you.
Thanks for coming back. We had you back on the show on August 12th of 2022. So it's been, I can't believe it, almost 2 years, not quite, but almost 2 years ago, we had you on the show for the first time. We got a lot of really positive feedback, and my plan at that time was to wait until some of these real estate deals came full circle to bring you back on the show and kind of close the loop, if you will, for the listeners. And obviously, that's we're still in the middle of a lot of these deals, but I thought it would be good, given everything going on in the economy and the state of things right now and the way they have been since that recording, to kind of give everyone a quick update and kind of catch us all up as to what's going on. So we decided to bring you back on the show here today, and we'll probably have you back here again at some point for hopefully closing the loop and giving us some great news on how some of these deals have turned out. But as the title of the show basically says, we're going to talk about the messy middle, as a lot of people would say, and handling the ride and talking about some things that could happen when you invest in certain types of private placements, specifically real estate syndications, and I know in your case, most of those are multifamily. So without further ado, please continue. If you haven't listened to it, listeners, go back to the August 12th episode. It'll make a lot more sense. But catch us up. What's going on since you've been on the show last time, and let's kick this thing off.
All right. Well, let's see. Back then, I probably had either 4 or 5 syndications that I belonged to, or that I was a partner in. One was the debt fund, like you said. One was multifamily. One had a hotel in it, but it was a multi-property fund, and that's where I was at. Oh, and I had one in a Class A high rise. So fast forward, currently out of those, I only have one that is producing distributions. One of the debt funds I was in, well, we're scrambling with lawyers trying to get our properties back because we put them up as collateral on some loans, and now we're having a hard time getting them back, even though we believe we paid the loans back in full. One of the other ones that I was in, it was one of the last ones that I was in. It came out of the gate and has never paid a distribution. There was some last minute financing issues there, and we were hoping to do our value adds to that property, and by the time we got through with the value adds, the interest rates had come up, and ended up doing a cash call on it. That one is kind of interesting. I kind of crossed swords with that syndicator. I didn't agree with the way he was going to do the cash call, so I didn't participate in it. The ramifications of that is I don't get distributions for the duration. However, I am still in the run for any equity growth in that fund. So I'm wishing him well, but I just did not like it. He was successful on his cash call, and following the progress of it, they're still struggling, but they're making it, and we still own the property, so that's a good thing, and we haven't had to do a fire sale to get rid of it, to try to get out. The Class A property that I was in has just been clicking right along. It handled the interest rates problem, no problem. It was the one, when we talked about it, we were struggling at the time with a swimming pool that's leaking. Well, guess what? We're still struggling with the swimming pool that's leaking. But they've been able to keep it afloat, and distributions have been on par all the way through it.
Let me interrupt you here for a second, because I know you got a lot of updates for us, but for the sake of the listeners especially, I want to go back, if you don't mind, to the comment you made about the cash call. So for those that don't know what that is, of course they can listen to the first episode to learn more about some of the deals you were in, but kind of quick Cliff Notes version, what type of deal was that, and then what is a cash call, and why did you choose not to participate? And you mentioned how that affected you distribution-wise, but can you elaborate on that part a little bit?
I can try to. It was with a multifamily unit in Texas. Again, whenever we went to closing, there was some last-minute negotiations, and we had to take a rate increase to get the deal across the line. The syndicator did that, which put us behind the ball on it. Also, the zero interest loan, the points, instead of being 3 years, turned out to be a year. So those were the things that changed at the last minute, but the syndicator went ahead and pushed that purchase across the line and bought the property. It was tight. He told us that after he did it, that it's tight now, but I think we're going to be able to make it. I think things are going to go good. And then the rate hikes happened. Cash call is where he's trying to buy down debt. In this case, he was trying to buy down debt. And he put a call out to everybody wanting them to invest 20% more than what they had previously invested in it. And I started talking to him, trying to figure out, one, what we were going to do, how we got here, and that's how I found out the whole history. But then talking to him, I just didn't have faith in the way he was doing it. He did not have the numbers and the information that I wanted before I put more money with him. Now, I done due diligence on this company before I put money with him, and I'm confident that he knows what he's doing. But I was very concerned that he was reacting versus having a plan, because all he could come up with was, this is how much we need to buy down this much debt, and that will make us float even, and hopefully we'll get rent increases to make our money and keep our property. So those were the basic reasons that I didn't participate. Now, I knew I may have participated if I thought he couldn't raise the cash call, but I was in talking with him and knowing some of the people that he has invested in it, I believed he would be able to come up with the cash call, and I didn't see me putting good money after what I considered bad, was what I told him at the onset of our discussions. But I couldn't see putting more money in it because I had lost faith in that property and the people that were managing it. And eventually he did turn over the managers of the place and started to get the occupancy numbers up. Did that answer all your questions?
I think so, yeah, but actually, yes and no. So I always have follow-ups. So yes, it answered a lot of them, but I guess my follow-up, one, would be just what was his reaction when you told him about throwing good money after bad? And two, when you decided not to participate in the cash call, can you talk about how that affects your investment returns versus the people that chose to put money in? How is that different?
They will continue to be invested at the same rates that they originally were at. I believe it. I can't remember what the coupon rate was on it, but it was something like 7%, 6% for the first couple years, and then up to 8, and then up to 10, hopefully. And it was supposed to be a 3 to 5 year hold on that property, so they were able to maintain their position and increase their position in the syndication. They, although my dollars are the same, my percentage of money invested in it, instead of having 100 investors, say, well, he had 197 investors. Well, although I have the same amount of money in it and I should get my money back, I don't get to participate in the distributions, and my percentage of the total will come down because these other people put more money in.
So you are effectively getting, or have gotten, diluted by choosing not to put money in.
That's correct.
Okay. But the money that you did originally put in, are you still anticipating earning a return on that, although it's just not representing as big of a portion of the deal? I guess I'm caught up on the not receiving distributions part. So did he somehow say, hey, people that are putting money in for this cash call, they're going to start participating in these ongoing distributions when they start up again, but for those that didn't, we're putting you guys on hold. But at the end of the day, hopefully, if all goes well, there's still an expectation that you're going to get your anticipated return. Am I following right?
I'm hoping to participate in the sale and any profits we make off the sale. I am not looking to make distributions derived from operating income during hopefully the ramp up of the property.
And is that because of the way the deal is proceeding, or is that because he somehow was able to change that for the new people to put money in and you chose not to?
That's correct. It was not real clear in the I can't think of the name of the document.
The PPM,
but we went through it, and I went through it with him on it. And what he did was he took a vote, and of even the LPs, I voted against. Everybody else voted for, so I was outvoted.
So basically, they took a vote. So it was written, for the listeners, it was written in this document, which is one of the several legal documents that are, able to be reviewed and should be reviewed and read thoroughly beforehand. It's called the Private Placement Memorandum. And so in there, it was a little bit, it sounds like, unclear or not,
Well, yeah, it was never expected that this would happen.
Okay.
So it was not identified and discussed in the document. If a cash call, what would happen if a cash call happened?
Okay. But there was some sort of a catch-all section, I'm assuming, that basically said any issues, and this kind of falls into that bucket by default because it wasn't specifically and explicitly mentioned in the PPM originally, any issues that arise, investors, LP, limited partners will take a vote on it to see how we proceed, and then there's like the majority percentage pretty much wins. Is that kind of how that shook out?
Actually, no. What it says is that the general partners get to make the decision, and you'll find that a lot that the limited partners don't have a vote. This was something that he done to get a perception of who all was willing to proceed and who wanted to proceed with the cash call, because the other option was to have a fire sale.
Okay. So they're going to make the decision that's presumably in the best interest of everybody, but just to kind of gauge the temperature of everything, he kind of put out this, I guess you can call it some sort of voting,
Yep.
or just to get a feel, but then he did whatever he wanted to do at the end of the day after he kind of took into consideration how the investors felt about it, even though they didn't have a vote that could determine what he does.
Correct.
Got it. Okay. All right. So basically the way things are structured now, you did not put money in for the cash call. You will participate on the back end in the profits. Hopefully there's profits. But in the meantime, distributions will only flow to those that put in money during the capital call. That's the way this thing is working.
That's correct.
Gotcha. Okay. All right. And it just out of curiosity at the outset, I think you mentioned you weren't sure, but maybe somewhere around a 7% or so distribution along the ride. Were you expecting, I'm assuming you were, that to be part of the deal kind of during your hold period?
Yes.
So okay.
The plan put together. He put together a chart showing the ramp up of everything and how much he forecasted, or the syndication was forecasting, that they would be able to pay on a monthly basis, and he broke it down into years. The first year 6%, second year 7%, that type of breakout. So you see the ramp up in the PPM on what they expect to do. Nothing's guaranteed because it's all high risk, but that's what you look at to make your decision. And just to put everything in perspective, this was the highest loan to value syndication that I was in. It was at 90%. I have nothing else as risky as this one was.
Okay, so for the listeners, 90% loan to value is basically they were taking on debt of basically 90% of the purchase price of the deal, and investor equity, or the amount of money they were raising as part of the syndication, would represent 10%. So they had a high debt amount or high leverage on this deal to start.
Extremely high leverage.
Yeah.
But I knew that walking in. Okay, that's not on them. That's on me. I wanted to be a part of that.
Okay. So, I mean, this, probably needless to say, but this has to kind of sort of feel like a punch in the gut or a kick in the teeth or whatever you want to call it, right? I mean,
well, it is currently, okay. I'm failing at the moment, but like I said, I have faith in this syndicator. I did the due diligence on him, and I think if anybody can turn a profit on this property, and it sounds like they're turning it around. They got rid of the operations group that was in there. They've raised the rents a little bit. Their percentage of places rent is in the 90s now, so they have a good chance of succeeding, and they're doing their renovations. Like I told you, that we had originally planned to take it from a Class B property up to A minus or a B plus, whatever they can get. And they hope to do that in 3 to 5 years. That is still the plan. 3 to 5 years, they hope. In what would it be, 26, that they'll be able to start looking for people that may want to purchase the thing, if interest rates will support it, or if people can handle the current interest rates and still buy it, which is, I'm hearing, is out there. So yes, I'm not going to make as much money as I had originally jumped in at that 90% loan to value, but I'll at least get my money back and hopefully a little bit extra.
Gotcha. And I think just, for the sake of the listeners, I mean, this is really interesting. I know we've talked about this offline, probably off and on, but I guess I didn't realize the whole part about the distributions being affected, the ongoing distributions by the cash call. But for the listeners, a lot of these deals, at least the ones that we've been in, the bulk of the money is generally made on the back end anyway. So even though as a limited partner investor, you might be, expecting to receive money along the way, relative to what you could get on the back end, it really is a smaller component of the overall total return, which I think is why I don't want to say you're okay with it, but you're basically okay with it because, like you said, you're still expecting to get your money back and then hopefully a chunk at the end anyway.
That's right. I won't know until he sells. Okay. So yes, I look bad now, but I'm holding on to the end because I think he may pull it out.
Yeah. And, just off the cuff here, just based on what I know and what you've said so far about it, I've not read the PPM for this, and I'm not an active investor or a current investor, passive investor in that deal. But I don't think I would have put more money in when a capital call was made like that, given the information that you provided, if the only or the main benefit would be, okay, yeah, keeping the deal alive, but more so like I'm going to be eligible for distributions along the way. Because in essence, you can look at it a million different ways, but you're effectively, best case scenario, maybe getting some of your money back in the form of distributions for the chunk that you put in when they do a capital call or a cash call, and you put more additional money into the deal. So I kind of like what you did, and I think I'd like to think I would do the same thing there, even though it meant I got to wait and see what happens on the back end versus chasing my own money essentially by putting more in and then trying to get it back as a distribution during the difficult hold period that they're in right now, or that they were in initially.
Yep. Okay, well, that brings me to another cash call that I had here recently with another multifamily, and it was a fund. They did a cash call. Now, it was for quite less, and it was a very large syndicator that had never had to do a cash call. But they put out all the information I wanted plus, and they had a plan. And, they've been floating the loans on the high interest because some of the coupons expired and they had to pay a higher interest rate. So I've worked with them and I liked it. So I did go ahead and participate in that cash call. But that's another one I am not currently making a distribution on. However, and since I did contribute, even though I'm not making or getting my distributions, they are crediting it to my account every month, showing that I am making my full distribution.
Can I ask what percentage of your initial investment, you said it was less, so I'm assuming less than 20%, what was their cash call percentage that they were asking investors for?
Cash call percentage was, it was like 17%, 17.25%. They had it down to the nickel.
Gotcha. Okay.
So, but again, it was very good. I had faith in them. Their plan. They had a teleconference or video conference. They got in front of everybody, went through the numbers, went through everything, showing how they were doing it. Talked about the properties. Again, I believe this is an 8-property fund, and they were showing, hey, these two in August are going to be ready to sell even at the current interest rates. We have people actively wanting to purchase them, and we're holding off on them at this time because we think there's more money there in about September is when they're hoping to be able. If September happens, if they sell those 2 out of the 8, that'll leave us 6. We will get our cash call money back and all of our distributions. And they had it all worked out money-wise, showing how it works.
Gotcha. Okay. So for the listener, lesson there, anybody can come back and ask you for money, or most of these deals, unless they specifically put in there that they can't, but a lot of them will usually leave it fairly open-ended to give themselves an out, if you will, if things don't go initially as planned or something crazy happens in the economic climate and affecting the real estate environment. But the lesson, I think, is that even if you're asked for funds, depending on the syndicator's response, what their plan is, how well they can articulate that plan, the fact that they even have a plan to begin with can certainly influence your decision as to whether or not you're throwing good money after bad, in which case you don't, like the first cash call example you mentioned, or if they seem to have a plan, they have their shit together, and it makes sense that you decide that you actually do want to participate in the cash call. Just because they're asking for money for circumstances beyond their control or foresight initially doesn't necessarily mean that, it doesn't probably feel great, but it doesn't necessarily mean it's a bad thing and you're at zero,
Yeah, correct. And in their defense, this happened in 2022 whenever we started this fund. It was one of the first funds I had invested in 2022. And that's back when inflation was transitory. So interest rates, we went for a year making good money off that until the interest rate rise. So, and nobody's seen that. I didn't see that going that high.
Yeah. The environment, I think, has hurt a lot of folks in a lot of different ways, and that's part of the reason that we're doing the show. Is Cube Crusher likes to give me shit about real estate's always rainbows and unicorns. Well, actually, no, it's not, and I think that's one of the reasons that he liked the show so much that we did with the Rent Reverend when he talked about the evictions, and I think the title of the show was Evictions Happen. So for any new listeners, feel free to go back in the archives and search for that show, Evictions Happen, featuring the Rent Reverend. But we like to show all sides of it. I'm a big fan of real estate. O-Dawg's a big fan of real estate. But there's times when things don't go as planned, and there's times where, you kind of have to be along for the ride, which is why we're doing today's show, because, we want to paint a complete picture and not just all the gurus out there that tell you how great everything is and there's no downside and you're going to become a gazillionaire overnight, because most likely you're not, Yeah. So you mentioned, I want to go back to the pool really quick. There was an issue, and you talked about this on your last show about, I think it was $100,000 repair to a pool that was on the third floor. It was a third-story pool, and there was some litigation going on because it happened shortly after closing. It caused some water damage. It was leaking, and your group thought that the seller should have known about that. What did you say? Did you say what ended up happening with that litigation?
It's still going.
Oh, wow. Okay. So surprise. Yeah. So here we are 2 years later, and that's kind of still up in the air. Okay.
But we have done the repairs and done everything we need to, but it did affect our cash. So they're trying to recover that cash. Yeah,
and that makes sense. And I guess just to draw an example, I keep trying to just chirp in some comments here for the listeners because, just to try to make this as educational as possible. I've had instances in some of my deals in the past where they talked about lack of funds or using more funds than anticipated for something that, in my opinion, could be foreseen, such as increase in property taxes. Well, how do you buy a property and then not account for property taxes on the new presumably increased purchase price that the investor group paid? I think the people on my side that I was with should have seen that coming. But something like this, like a pool that sprung a leak, that's not really something that should be obvious. Yes, there's always going to be a risk. If you have a pool, things can go wrong, repairs can happen, but there's shit that happens just out of the blue like that nobody can foresee. And so, that's part of the deal as well.
And we had money set aside in this fund to take care of unknown unknowns. That was part of the money that they had put up. So we were able to pay for it out of that fund, and we are just trying to recoup the money, or that account, trying to recoup the money into that account.
Gotcha. Okay. You mentioned, I think at the beginning of the show, you had maybe 4 or 5 syndications back when we recorded last time, and I think, and you might not have said this on this show, but I think our last talk we had, you were somewhere in the neighborhood of about 10 now. So any other than what we've talked about so far today, any major lessons learned? Can you talk about some of those new deals? Any differences in everything from like the structure of those deals, if they're different at all, like the amounts you've invested, were they bigger or smaller, same operators, different ones? What can you tell us about the then until now?
Well, from then until now, out of here, let me put it this way. Let's see, I had one, two, three, four, five original, and only one of them is paying out of the five that I'd originally invested in 2022. In 2023, I invested in four more. Now, since we were into in 2023, I invested in them. The high interest rates had started, so I was not as anxious to get onto the higher loan to value properties and speculation. I stuck with a lower. I also diversified a little bit. I did invest more money than what we had originally invested, but I invested in some multifamily, storage, trailer parks. I spread that money around because I was concentrated, I felt, heavily in multifamily. So I spread it around a little bit. I was more cautious on the money. I always wanted them to have a fixed rate loan if they could, and have very little loans that required changing, or interest only loans that evaporated, had a 5-year life on them, or a 3-year life, or a 1-year life. They do a lot of gap loans in this business to make things work. So I rode those guys hard on the second set, just knowing what I'd known, and most of my loan to values now on the new ones are down 75% or lower. I'm down to one that is at 45%.
Yeah, that's pretty conservative in a good way on the 45, and the 70 to 75. I feel like that's, I don't want to say fairly common, but somewhere in the standard range in terms of how much equity they're raising versus debt. But that's good, and I think your point is that these are fixed rate loans; they're not adjustables.
That's correct. And if they are adjustable, it's out 7 years, and we're hoping to only hold 5.
Gotcha. Yeah. And I think a lot of syndicators out there, sponsors out there, are getting used to some of these questions. There's one group that anyone that's a premium subscriber knows who we're alluding to. I won't blast them out here, although they're a great group. We both invest with them in full disclosure, but they are very vocal about the fact that they have a very high percentage of the overall fund, and in essence, the overall portfolio that has any leverage at all is fixed rate. There's very, very little that's floating rate. And if it is, there's a darn good reason for it. And I think they're used to, and a lot of other operators and syndicators and funds out there are getting used to, or have gotten used to, investors asking those questions, because everybody has seen just a rapid rise in rates in general, whether it's from deposit rates on banking accounts to mortgage rates on single families, commercial rates on apartment. I mean, you name it, everything has pretty much risen in the past couple of years as far as rates go. So a lot of those guys are, or at least should be, anticipating those questions, and I think some of them have restructured or are structuring in such a way that they can answer with confidence to investors that yes, all or a high percentage or portion of any debt we have is fixed. And if not, they can usually explain why, and they better have a good reason for it.
Correct.
Yeah.
So that's the difference between early 2022 and 2023. Now in 2024, I've got some dry powder, but I'm not putting it out because I'm not sure what's going to happen when. So right now I'm holding off, although I do have one fund that I am reinvesting all of my distributions in to up my percentage of holdings in it. But other than that, I'm not looking to purchase any syndications currently. I'm going to wait till last quarter of this year or next year before I put out any more syndications or pick up any more syndications.
Yeah, and the fund that he's talking about, it's a somewhat unique, in my opinion, structure that they allow for reinvestment, the way that they're set up. Some of these funds will allow for that. Others won't allow for that. They're going to force you to take distributions as cash. So that's another thing for the listeners, that if you guys are thinking about or looking into, real estate syndications or funds or whatever the case might be, that you want to make sure you have an understanding of what that looks like, and more so a plan for what you're going to do with those distributions when they come in. If you can't reinvest them into that fund, are they going to go into a side account that you're going to kind of stack some cash for your next deal or next syndication? Are they able to go back into the fund, and do you want to have them come back into the fund? Or, and what I personally do or have done up until this point, is to essentially accumulate those and reinvest them into more liquid investments. So I'm not necessarily putting them back into a particular fund. They're kind of just accumulating so that I can deploy them wherever I want to deploy them in the future. So there's no right or wrong answer to that. A lot of it is very much a personal preference, And speaking of, this is kind of I think a good segue to one thing I wanted to talk about today, which is personal investment philosophy. We're not going to spend a ton of time on this, but for those that are premium subscribers, there's a Cash Flow Kings picks that I send out every now and then, and we've sent out several different things. If there's something that either I'm doing or interested in or think that people should know about, it's something that a lot of times I'll put together a PDF document and email it out to any of our premium subscribers. There's actually a course that I'm probably about 80% of the way through. It's a free course. It's fantastic. And there's especially a section on personal investment philosophy that I think is really, really good. And I've gone through that just the other day myself and kind of put some pen to paper and took a look at some different things along the spectrum. We don't have time to get into all that today, but just a quick heads up for those of you guys that are premium subscribers, you'll be getting something from me here in the near future. I'm trying to wrap up or come pretty close to wrapping up that course before sending it out, but it is something I would encourage everyone to take a look at. So you guys will be getting that soon. So I just wanted to make sure that I mentioned that. Let's see here. Oh, and then just real quick, a couple things I wanted to just touch on, make sure we got to. You mentioned some investments that you made. I personally have only made, I was going back and I looked at the deals that I was in, basically since I started doing this. And when we recorded our last episode, there were some that I put money into in 2021, 2022, some well before that. They kind of led up to that point. But since our last show on August 12th of 2022, I was actually kind of surprised when I took a look back. I've only made one new syndication investment, and I think it's one of those other ones that we're both in. This was back in March of 2023. And when I went back and listened to our original episode, I went back and double-checked on this too. You made a point, and I really liked it. And if the listeners, if you guys missed it, it's probably worth reiterating here. And that is, one of your requirements was that you as an investor get your money back before the split happens and the general partner takes their cut. And so I went back specifically to that investment because I know not all my deals have done that, but I really liked that. And it was one of those things where I thought, back in the day, it's kind of a nice to have. But the more I think about it now, it's something that I'm not going to say it's an absolute deal breaker if that's not the case, but certainly is preferable. And so in this particular deal, they do have 100% to the limited partner, but until they get 100% of their principal back, 100% of the operating cash flow goes to them until they get all their money back. And then it goes to a split. In this particular one, it's a 70-30 split after that. And their plans to get the investors their money back within 5 years. And this one is unlike some of the other syndications that are normally 3 to 5, 3 to 7 year holds. A lot of these funds out there, and this one in particular, are starting to target, at least from what I'm seeing, longer hold periods. So this one is more of they actually have it as a 10 to 20 plus years, but I've seen a couple of 10-year targeted hold times, which is interesting as well. But that's the only one that I personally, if anybody cares or is wondering, have invested in, since our last show. A lot of the other ones, similar to what O-Dawg was talking about, I went back and I keep everybody has a spreadsheet for everything, but I have a couple of tabs on there for what I track investment cash flows. And if I look at 2023 even, and then look at 2024, things really started to get rough for my personal portfolio right around March of 2023 is when a lot of these distributions either slowed down or stopped completely. And if I pull up the one from 2024, of the 9 active syndications that I'm currently in, I've had a few come full cycle, and if we have time, I can get into some of those numbers that I ran for the show beforehand. But only, let's see here, two of those are actually paying out consistently. There's been another 1 or 2 that have made a distribution, and then for whatever reason have pulled back. And so, again, we've talked about this on today's show. There's a lot of different reasons for that, but I think we're in the messy middle. We got to be able to hold on for the ride, and obviously it sucks when that happens, but it just goes to show that anything's possible. But to O-Dawg's point, it's not over till it's over, and I think a lot of these things are going to come out fine on the other side. There's going to be some that don't, but in the meantime, you need to be able to hang on, and just because you see something in a brochure that says this is the expectation and what we're going to be able to deliver to our investors doesn't necessarily mean that's actually what's going to happen when time goes on. So I just wanted to shout that out there. I wanted to go back to something you mentioned on the last show with regard to syndications and funding these syndications. You had made a comment on there about you were at the time pretty much brand new or relatively new to doing that, and you were talking about funds and how they have their different requirements, and it was really good conversation about minimums and how they can be negotiable. Again, for the listeners, if you haven't checked out that episode, go back and listen to it. But one of the things you mentioned, I think it was towards the end of the episode, was using home equity or essentially debt to invest and making money on the spread, that positive financial arbitrage. And my question is if you have any updated thoughts, or what are you thinking now? Do you still like that approach for investment, or have things changed in your mind?
I think I'm still okay with that approach. I'll give you an update, though. I did take out a home equity loan to do my first purchase in 2022. Interest rates got down to 2.875, which was lower than what my interest-only loan was on my home equity loan. So I remortgaged my house at 2.875. So I took that money and now I'm paying 2.875 on it. So I think I come out way ahead.
What about for those that have equity today? Interest rates have shot up. A lot of prices in certain markets for somebody's home, let's think, primary residence in a lot of areas have gone up. If somebody is thinking about investing in syndications, and we don't give any advice in the show, but just your personal opinion, if they have equity that they can tap into, generally speaking, do you think it makes sense at this point to do so, and why or why not?
As a rule of thumb, I would say no, because the margins, I just don't see it. And unless you can beat my highest dividend that I'm getting right now is 9%, and that's in a multifamily preferred equity fund. But if you got to pay 7 or 8%, which is what I understand is out there, maybe you can get it for less. That just really narrows your window. I was looking at 8 and 9%, and I was looking at making 8 and 9% on these syndications that I was in, and I was paying 4%, 3.5%. So I had a lot of running room there. Whenever you lose that running room, it just increased the risk. Now, if you've got something that you believe in and know that it's going to work, then yeah, I would do it. But I've got enough of them out there now, and I am retired. I am not looking to run that high of risk. I will still invest in a high leverage fund if I see one and I like the operator, but those are getting fewer and farther between. Like you said, just about everybody got burned on this interest rate rise, so everybody's getting more conservative.
Yeah, I would agree with that. So again, not advice to anybody, any of the listeners or anything like that. But yeah, I do think that the deals have certainly gotten tighter and tighter. And I think Cube and I had an episode, and he was talking about, I think we were doing this might have even been a premium episode, I can't remember, but we were talking about the risk-free rate of return and what that is. And if you compare that and something like, treasuries versus what the anticipated, yield is on some of these syndication investments, there just isn't enough additional possible return there to justify for a lot of people taking on that added risk. I'm not retired yet, but even for me and my risk profile, which I generally consider fairly aggressive overall, and that's mostly reflected in my stock market based investments as far as my, aggressiveness and equity positions and, that sort of thing. But even I, at this stage, as tempting as it can be, I just don't think it makes any sense to do that. In fact, I don't remember exactly what the number was, but I had sent an email to our primary residence mortgage. It's really weird how it's always changing hands to a new servicer, it seems like, in the industry. And so in this particular case, it went from the company, it was essentially the same company, but there was a slight modification in the name, and it went from one arm to the other arm. And when you log into the website, it's the same loan officer, and basically she had a little button on there that said like, access your home equity or whatever, you can tap into it. In fact, I'm going to look this up live while we're recording if I can search the folder, because I just, for shits and grins, I decided, let me see what's what's possible as far as that goes and what that would be right now. And I shot her an email just to see, and it took her a little bit to get back to me, and then she gave me a number, and I was like, I'm good, thanks. Let me see. So this was this is about a month ago, it looks like, on April 10th. And she said at the time, you would be looking at the following: 80% loan to value was 7.575 and 75% loan to value was 7.375. That was about a month ago. So that could have changed, but we're pretty much in the mid sevens. So does it make any sense, even on a primary residence where presumably the risk for the lender is less because you're living there and more likely going to make the payment? That's a whole separate conversation. And you're in the mid sevens to access that equity and then take on additional risk in the form of, if shit hits the fan, it's your personal residence on the line, to take that and try to do better than that on some other type of investment. I think in most cases right now, it just doesn't work. So again, not advice, listeners. You can do whatever you want to do, but it sounds like O-Dawg and I are in agreement on the fact that it's going to be pretty difficult to make that happen right now.
Yeah, but if either one of us decides to do something, we're going to do it.
That's true. And in full disclosure, I've been trying to talk myself into and out of simultaneously, which I know is like a oxymoron, but it's to buy another single family turnkey rental. And I've had this conversation with several folks in my little circle, and I just can't get myself to do it on the one hand, but on the other hand, I want to. There's a phrase out there that talks about, marry the property, date the rate. And so depending on your portfolio and depending on your cash flows and depending on your risk tolerance and risk capacity and all the things we always talk about in financial, in the financial world, is it possible to get into something now at a particular rate that's higher than you'd like it to be, only to potentially refinance later at a lower rate? And I think as a one-off, in some cases, certain people maybe can do that, and I could probably swing it. But at the same time, if it doesn't contribute to the overall goal of increasing, at least in our situation, we're trying to increase current cash flow, and I don't think that would do that by a very wide margin at all, then it really doesn't fit and therefore shouldn't be done. And sometimes, even though it's like you have two little people on your shoulders, right? I got the financial advisor, cash flow king, saying, don't do it, stupid. And then on the other shoulder, I have the other one that says, oh, it's fine, it'll work itself out. And it's just like this tug of war. So if anybody else is having those thoughts internally or conversations externally, I can tell you, you're not alone.
That's right. You got to speculate to accumulate.
I like that. Did you come up with that?
No, that's been around for years.
You got to speculate to accumulate. That's interesting. Okay, all right.
Yeah, and when everybody else is going one way, it doesn't always hurt to swim upstream.
But just proceed with caution. Don't do that with your last dollar. Don't do that if you have no other investments. Don't do that if you if your situation can absorb it. I think that's the key, right? Because
Yeah.
sometimes people say, well, I'll buy a house and it has a negative cash flow of 100 or a few $100 a month or whatever. And it's like, okay, if it's a one-off and the rest of your portfolio can support that, or, you can just do it from your job. If it's just a few $100, whatever, fine. But could you build a portfolio of 100 houses on that? Of course not, right? So you just got to be careful.
Yeah. And that's what I was kind of going to lead to. I think I done some over the top due diligence on all of these 9 funds. I went into the weeds, and I still have problems, have challenges. So no matter what you think or how hard you work at it, you're still going to have challenges, and it's not going to be an easy road. You got to be able to stick with it and add money to some and not add it to others, and ride it out to the end and see what happens, because that's when you'll be judged.
Yeah, and I think that's one of the major benefits, just in the, it's kind of cliche and probably overstated, but diversification in general, I think that's why it's talked about so much, because it's easy, or easier, I think, to have 9, 10 syndications out there, plus other investments in other areas, and have things take a turn and several of them go on pause. No matter what, even if you think 1 or 2 might go belly up, you're probably going to make up for it and then some on the other ones, and that's just part of the game. Speaking of the last thing that I wanted to cover here real quick, I did prepare on, and I wasn't sure how many they were. These all are with the same syndicator, in case the listeners are curious. I had 3 deals, 3 real estate syndications, all of which were multifamily, that actually came full circle. And I wanted to we probably still will do a bigger episode on some of the funds that we're in and stuff like that in the future, and talking about that. But in this particular case, this is with a group that I won't name them. I will tell you O-Dawg likes them, and Cashflow King is not a huge fan anymore. I still do have 2 active deals with them at the moment, neither of which are paying, by the way. But these 3 deals I did with them when I very first got started. In fact, 2 of these started in 2017, and then one of these was in 2021. So I just had some quick numbers that I wanted to share with the listeners. This is back when I was investing smaller dollar amounts. Not that I'm investing that much more now, but the nuggets, as I like to call them, or the chunks of cash that get thrown in, get a little bit bigger over time. But at the time, I really didn't have a ton. And so at least in the real estate space, so I started this first one. This was a 50-unit deal in Beech Grove, Indiana, that I invested back in August of 2017. I put a little $20,000 nugget in there, and we were completely closed out by January of 2020. So it was roughly 2.5 years-ish, something like that, maybe a little less than that. And I ran in Excel just the XIRR function for the geeks and nerds out there. So we're basically looking at different dates and different cash flows. So I have, my initial investment that goes in, and then I have my distributions on the days that I got those distributions and what those amounts were. And in this first deal, they were kind of sort of all over the place. And then, of course, I had, essentially the exit. And when I run that back to see what was my internal rate of return, if you had to annualize that over the hold period, that one, which quite frankly, I didn't think I was going to get my money back. I really didn't think that I was going to get my money back. And even though the return is not great, I was kind of sort of thrilled to death, because it was going really, really bad in my opinion. It was just too small of a deal for them to syndicate, I think. But anyway, it came out to a 9.39% XIRR. So 9.39% internal rate of return over a period of about 2.5 years on a 50-unit deal in Indiana. So that was the very first deal that I did. And again, I put $20,000 in. And then the second one, this one actually was, I think, the best of the 3. These are the type of numbers that I'd like to see. And of course, everyone would like to see higher numbers, but I think this is worth mentioning here. So this one, I started at the very end of 2017 for $20,000. And this one, it looks like, ran for about 3.5 years. It finished up in May of 2021, and then there was a little pittance of a closeout distribution in March of 2022. But I did the same thing. This particular deal was 80 units, and this was also in Indiana. It was in Indianapolis, Indiana. I know we got some listeners out there. This was an 80-unit deal back then, and when I ran the XIRR function, it came out to a 17.5% return there. So I was pretty happy with that. And again, that's been the best of the 3. The last one really sucks. This was a And this was a bigger deal, actually. This was 160 units in Greenville, South Carolina, and things really started to take a turn, and they just wanted to get out. They had a chance to get out, and they did. So this one was a shorter hold. It was a little over 2 years. It started back in March of 2021. I threw a $20,000 nugget in there, and we closed out in June of 2023. Ran the same numbers and calculation. That one was a measly 5.26% ex IRR. So none of these were home runs. I think the middle one was pretty good. I think most people would be happy with that, especially if you're just a stock market investor and you're used to a 7, 8, 9 even percent average annual rate of return. 17.5 is pretty good. 9.39 also pretty good. 5.26 kind of sucks. But just to give you an idea of what I've experienced so far, and quite frankly, I'm hoping that the other deals that I'm in now, where I've invested higher dollar amounts, I have a lot more conviction and faith in these other groups, syndicators and funds, and I'm hoping for numbers that are even above the second one that I've been in. So I just wanted to share that with everybody. You got any thoughts on any of that?
No, I'm not even hurt by the 5, because sometimes the stock market does that. So again, if you diversify, you're going to have some winners, you're going to have some losers, and some that do okay. So
yeah.
I think for diversification, you did fantastic.
Yeah, it's not bad. I mean, the other thing we look at is equity multiples, right? If you take the total amount of distribution, so ongoing distributions plus the money that you get out at the end, and you look at that as compared to the money that you put in initially, what was your equity multiple? So it's essentially your total distributions divided by the capital that you invested. And these were anywhere from a 1.12 to a 1.66 is what I'm showing. So not terrible. Not the 2 or 2 plus that I'd like. Not the 1.7, 1.8, although one of them was close. But yeah, I mean, not horrible, especially for somebody that really was brand new, just getting started, and quite frankly, 50 and 80 unit deals, in my opinion, right now, I don't think I'd invest in them because they're just a little bit too small. Even though coincidentally, the 160 unit did the worst, I think you typically need to have 200, 300 plus units, give or take a little bit, for a lot of these deals to make sense to have somebody incur the expenses that are going to be there to syndicate them in the first place. I don't think you should be raising money for a 50 unit deal. But hindsight's 20/20, and those are some lessons learned as far as that goes. Do you have any, I have one other thing I want to mention, but before I do you have any final thoughts for the listeners or anything you want to cover that we didn't talk about yet?
The only thing that we didn't talk about that I definitely wanted to get out there, if you remember right, I invested in a new build hotel in one of my funds.
Yeah, I remember that.
It took it a year and a half. We were 3 months away from getting permits. A year and a half later, we got the permits. It's finally built, and we're making money.
That's awesome. That's good.
Yeah.
Because I think, if memory serves, that was a 3-property fund, and the hotel portion of it was going to be sort of no cash flow for a little while you got things ramped up, and the other 2 were going to be they had a current pay on them. So now all 3 properties in that fund are paying. Is that right?
That's correct.
And is that fund currently paying distributions to you, or are they on pause?
They're on pause right now, but they're expecting to start them up.
Good. Yeah, that's the other thing for the listeners, probably worth mentioning. As we're tracking this stuff, we had one fund. This was for mostly mobile home parks. We had, I believe it was North Dakota and Missouri, where they paid out their first distribution. And we weren't expecting anything to, be lighting the world on fire, but they finally did turn that on, which is nice. And it was right around the time, maybe, a few weeks, but that's really nothing, later than initially expected. But even some of these other ones that have been on pause, I've noticed in some of mine that they're talking about ramping them up again or getting them started again. And so that's always a good feeling, because you kind of feel like, okay, we're hopefully going to start to come out the other side on some of these. And just because, for the listeners, some of these have paused distributions, yes, it's created, the economy's created some challenges and the interest rate environment has created some challenges. But at the same time, if they're doing it for the right reasons, you can look at some of these syndicators and operators and say, you know what, that's responsible. Because if your interest expense goes up because rates went up, and maybe you had a variable loan, for example, and you need to have those extra funds available to cover that and to build up a reserve, I think all investors, or virtually all investors, would agree we'd rather not get paid in the short term to allow them to accumulate what they need to keep the property and keep it afloat and not go back to the bank, and then pay us when they're able to pay us, as opposed to continue distributions, completely spiral out of control, and then they lose the whole thing back to the bank anyway, and there is no profit on the back end. Would you agree with that?
I would definitely agree with that.
And that's been a tough pill for me personally to swallow. Is a cash flow investor, as my name sort of, basically states, the cash flow king, and then that's kind of what I'm after. And so, I track things a little bit differently, I think, than most, but one of the things I'm most interested in generally is, okay, what does the cash flow look like? Are they paying consistently when they say they're going to be paying? Is it going up? Is it going down? And I think one of the lessons that I personally learned through all this is sometimes you have to look a little bit deeper than just surface level stuff. I can't just say, hey, so-and-so fund paused the distributions, those fucking a-holes, right? Like, I can't just look at that, because I have to look a little bit deeper and say, well, wait a minute, why did they do that? Are they ultimately pausing paying us pennies to protect our dollars? And I think in a lot of cases that's what's happening, and it just takes, as you and I and everybody becomes, further along in our investment journey, you learn and pick up different things. And that's one thing that I've learned, is that I need to, I don't want to say stop being short-sighted, but I can't focus exclusively on the cash flow, especially when there's an underlying reason as to why that might need to be temporarily paused. And as long as that's all it is, and we're hopefully going to come out the other side, and there's a plan in place on the part of the syndicator, I think that, again, most investors would agree that that's probably the direction that we want to go, and that we're okay with that. And I personally have kind of, again, it sucks, but at the same time, I get it. And so, I'm trying to talk myself into the fact that it's okay. Life will be fine, right? So, last thing I wanted to mention was the book. We have a link in the show notes. We had one in the last episode from August 12th of 2022. I'm going to go ahead and put it again in the episode here. We both read a book called The Hands-Off Investor. It's a really, really great book. There's a link to it on Amazon. You can pick it up. I think Amazon even has a trial now if you do. I'm not one for listening to audiobooks, but whatever their audio thing is, Audible maybe or something. I don't know if that's right, but you can like do a trial and it's $0. Or if you pick up the paperback copy, I think it might be like $13 or $14 or something like that. So anyway, if you choose to pick up the book, it's a really good book. Anybody that's interested in syndications, we both read the book. We both really liked the book. There's a lot of things in there that kind of forces you to think, I don't want to say differently, but in some ways outside the box, what to look for, and just, not to step on landmines. And I think we're both better investors for having read that. So if that's of interest to you, feel free to go ahead and use the link to pick that up. The show might make a couple pennies, and we certainly appreciate it. So, and by the way, it won't cost you any more to buy the book. It's just an Amazon Associates link. And actually, I don't make anything. My wife does. She might make like 10 cents or something. I don't know. So anyway, but we appreciate your support. So, anything else?
No, I would just say that my book is dog-eared because I also use it for reference whenever I'm reviewing syndications. Yeah,
it's one of those that you buy and you hang on to. And like you said, you reference it when needed, and going back over the different chapters. And probably one of those books, if you read it more than once, you're going to pick up something that you missed the first time. So it's just a really good thing to have. And I'm, like I said, I don't like audiobooks really. I like to have an actual physical copy of a book in my hand. I'm just one of those. So anyway, check that out. Don't forget to text the show. Send us a text message. Check out the link in the show notes. You can just do that with a quick click. Send us a message if you like the show. If you don't, then whatever. You can send us a message anyway, I guess, and sooner or later I'll be able to text you back and tell you to fuck off. No, I'm kidding. But seriously, we would appreciate feedback from the listeners. Our email, as always, realtalkpersonalfinance@gmail.com. Premium subscriptions are available. Check out the benefits of that. We try to keep it affordable. It really does help support the show. We don't put any ads on the show, and part of the way we're able to do that is through the financial support that our premium subscribers provide to the show. And again, you can check out the benefits. There's a link in the show notes for that as well. So with that, I think we will wrap. Thank you, O-Dawg, for coming back on the Real Talk Personal Finance podcast. Thanks for being a premium subscriber, and I'm sure we'll have you back on again to talk about some more real estate stuff once we have some more things happening out there in the next little bit.
Sounds good.
All right. Thank you very much, everybody. We will see you in the next episode.
Check the mic and make sure it sound right, boys.